All right, hopefully everyone can hear me. We're going to get started in just a quick second here. I'm just working on getting the slides up on the screen. One quick second here, and we should be off to the races. Okay. If you could let me know that you can see the actual video, can you just quickly message in the chat window to let me know that things are working? Can you hear me? Can you see the screen? Can you hear me? Can you see? Okay, perfect. I will say I can't hear you guys, so what I've got is my phone up and running, and what it does is it shows me if you guys are chatting or sending messages back and forth. If you could, or if you have any questions as we're going through this, just feel free to post them to the group chat, and then sorry, I can see those live, right? So if you guys are asking questions, I can see them on the on my phone. You won't be able to see me, but you can see the slides. Again, what I find is that this is lagged by probably 10 or 15 seconds or so. So everything I kind of go through, it'll eventually come to you guys. I do apologize if I'm being a little bit repetitive or if I answer your questions a little late, just because they are coming through a little bit slowly. All right, so the plan today is we were going to initially discuss and review the topic of inventory just to make sure that we had covered everything. But again, I've given you guys that problem set. I do recommend you go through both the inventory costing questions, so looking at FIFO, weighted average, perpetual, and periodic journal entries, and go through all of that. The plan today is we're going to look at and start on property, plant, and equipment. This is a fairly heavy topic. PP&E covers all kinds of stuff. The idea of buying buying property, plant, and equipment, which costs go into it, and then ultimately selling it. So just be aware that there's a lot of transactions that you're going to have to learn to account for in this topic. Budget your time accordingly. You know, you've got the reading week. That is why I did schedule this ahead of reading week, so that it gives you that extra week to kind of play catch up on the rest of assets. Okay. So in this chapter, we're looking at property, plant, and equipment, goodwill, as well as intangible assets. The emphasis in this chapter, though, are on the assets you can touch, the tangible assets. Okay, what is property, plant, and equipment? First of all, I want you to realize that property, plant, and equipment includes those assets that are being used in the business. Okay, so if Dell has a bunch of laptops and some of them they've got put aside because they're going to sell them to their customers, that's considered inventory, not PP&E. Now, a laptop that Dell is using, even if it's a Dell laptop that they plan to use in their business, that is considered property, plant, and equipment. Okay, assets are tangible, right? So PP&E, what we're talking about here are those assets you can touch. They are relatively expensive. They last a long time. So the idea is usually beyond the current year, and sometimes for several years. And then the idea here is we depreciate them, like we looked at in chapter 3. Their cost is spread out over their useful life. They can be sold. They can be traded in. Okay, before I go any further than this, again, I really want you to be aware of what is property, plant, and equipment. It looks like there are 16 of you online, so there are quite a few. We are missing half the class, but I'm hoping that this then can be recorded and then ultimately shared with you guys back on D2L. Okay, the first question that we're going to have to do is figure out what is the cost of property, plant, and equipment, and how do we measure the cost? Like we looked at in some of the earlier chapters, we use the cost basis for measuring property, plant, and equipment. And the idea there is that on our balance sheet, we will keep PP&E at its cost. We don't show the depreciated amount. What we do is we take our cost, we show accumulated depreciation, and then calculate the net book value of property, plant, and equipment. What goes into the cost is the sum of all of the costs incurred to bring it to its intended purpose, net of any discounts we receive. The next few slides walk through the different types of property, plant, and equipment, as well as the different costs we include for each of them. Again, this is one of those topics I would strongly encourage you guys to. Oh, sorry, Alex just mentioned here 6 people in class watching projector. Awesome. Okay. Well, hi guys. For those of you who are watching this live, I'm glad you were able to safely make it to campus. Okay, the cost of land includes the following. It includes the purchase price. If you have any brokerage commissions that you've got to pay your real estate agent, you include those as well. Your survey costs, any legal fees to purchase the land, any property taxes that are in arrears, those would be necessary to pay just to buy the land. And again, the thing to think about here is, did we incur the cost, and was that cost necessary to buy the land? If the answer is yes, generally it's included as part of its cost. You've also to look at the costs of grading the land and preparing it for its use. If you've never heard the term grading before, some land is on a really steep slope. So think about those homes or those buildings in San Francisco where they're on a really steep hill. Well, there you're going to have to level out the land. That is included as part of the cost of the land itself. Now, land is not depreciated, and it's not because it goes up or down in value. It's because it has an infinite useful life. Okay, so to spread out the cost over the useful life doesn't really make sense, given that land is infinitely useful. For those things we do to the land, like paving it or putting a fence on it, we track those in a separate account called land improvements. Okay, let's look at measuring the cost of land. Here we've got the price of land of $500,000. We've got all of those additional costs and then total cost of land. Now, just be aware, a really common question would be something like, if I paid an architect $5,000 to, I don't know, determine the slope that the land would need to be to build a building. Well, that cost would probably be part of the cost of the building, and there we would debit building, credit cash. If you've got an old building that's on the land that needs to be removed so you can build a new building, that would be deducted from the cost of the land. My apologies, it would be added to the cost of the land. I will say, by the way, that just from a personal note, this is really quite awkward not being able to hear you guys or see you guys. So I am going to do the best I can to keep this as engaging as possible. I do ask, if you do have any questions as we're going through this stuff, please just post it on the discussion board so I don't feel like I'm in a room in my basement talking to myself, which is quite literally what I'm doing here. Okay, land improvements, the big thing to think about here is, what is a land improvement? It is things like lighting, signs, fences, paving the land, any sprinkler systems you put on, even landscaping, right? That has a future benefit. So all of those additional costs are included as part of the cost of the land itself. The entry to record the cost of land improvements is to debit land improvements and credit cash. If you plan on building a building, any fees you pay to architects, any permits you incur, contractor charges, materials, labor, and overhead that are part of the building, these are all included as part of the cost of the building. For equipment and machinery, we include the purchase price, transport charges to you, any insurance in transit, any provincial sales tax. So here you can't include any refundable sales tax. If you're going to get the money back from the government, you couldn't include that as part of the cost of the machinery. Any purchase commissions you'll include, installation costs, and testing the asset to get it ready for use. So just be a little careful here. That does not say training. The cost of training an employee to use the equipment would be an expense, right? We don't get future benefit from training our employees because it's the employee themselves who have that training. They could leave, right? We don't have to. They don't have to stay. You could have paid money, a lot of money, in fact, to train those employees, and they could still leave you. So what we're looking at here is what has a future benefit that has to do with the equipment itself. That includes everything like the transport costs to you, the purchase price itself, any installation, and so on. Once it's ready for use, we stop adding costs to the cost of the equipment unless we make the equipment better or last longer through what's called a betterment, which we'll talk about a little later on. Okay, any questions up to there? There are times we'll lease a space as well. If you're thinking about opening up a business downtown, let's say, You're not going to buy the Bentall Center just to open up your business, and instead what you'll probably do is you'll lease it from whoever owns the building. You still will make significant capital investments into that leased space to make it look like your business, right? You'll paint it, you'll install the special equipment, you might install an office desk or all kinds of things like that. Now, those are leasehold improvements. And the thing with those is they are separate and distinct from the building itself. Okay, and again, their depreciation does differ, right? You'll depreciate them over the life of the asset or the lease, whichever is shorter. And we'll come back to that a little later on, but that's an important point, is that if you're leasing a space for 5 years, even if you've got a piece of furniture that might last for 10, if your lease runs out after 5 years, that furniture is no longer useful to you, right? And this whole idea is we're looking at depreciation over the useful life. Being able to think about what goes into each category is really, really quite expensive. Or not expensive, but important. Okay, the next thing we're going to look at here is this idea of a bulk purchase or a basket purchase. I will tell you right now, guys, as a friendly hint, this tends to get tested fairly heavily. It's a really common thing to happen, right? Where you buy land and building or you buy different assets together at the same time. So here you're paying a single price for several assets as a group. The assumption is that Kawartha Dairy purchases land and a building for a combined price of $540,000. The land and building are appraised at $200,000 and $400,000 respectively. So our question is, we've bought $600,000 worth of stuff. How do we take that $600,000 and spread it out over the assets we only paid $540,000 for? So let's think about that. We paid a total combined cost of $600,000. We received assets worth $600,000, but what we paid was $540,000. The way we're going to do this is we're going to break it out. We're going to say, look, the $200,000 we paid for the land is 1/3 of the total value we acquired. We multiply that by the purchase price, and we're going to get $180,000. Do the same thing now for the building. 400,000 over 600,000 gives you 2/3, times 540 gives you 360. So the way you would then record this is to debit land for 180, debit building for 360, credit cash for 540. Even though the land and building together are worth 600,000, we still record them at their cost. The chapter also gets into what's called a betterment versus a repair. A betterment is something we do to an asset to increase its useful life or its capacity or its efficiency. Okay? Repairs don't extend the useful life or capacity, they just maintain the asset in the working order that it was in. For repairs, we're going to use the account repairs and maintenance expense. But for something that's going to make the asset last longer, we debit the asset itself. There's a question in the notes here saying, can I go back a slide? I'm not sure how long ago that came up, so let me just quickly back up for one slide here. Tanvir, was this the one you wanted to see? One sec, guys. Just, I think this is a bit delayed. This one here? Perfect. Awesome. And again, guys, I will save these slides. I think this is just actually going to share to my YouTube channel after all of this is done. So at the end of this, if you wanted to watch this again, feel free to do so. I just ask, please don't remix me or have fun with my voice. So there you go. Okay. Are there any questions about betterments versus repairs? A betterment increases the useful life. A repair just keeps it in good working order. Here's an example for you. If I put a new roof on my house that extends the life of the house, that would be considered a betterment. If I just do an oil change in my car, that's a repair. Okay, repairs are expensed, but betterments are capitalized because they have future benefit. Now, keep in mind that this gives some latitude to management to manipulate the price if they wanted to, right? Um, a company could capitalize a cost that should have been expensed. When you capitalize something, what that means is you're putting it on the balance sheet and you're not expensing it right away. That makes your net income higher than it otherwise would have been. So you've got to be a little careful here because, again, this could create an ethical dilemma. The idea that we have to come back to over and over again is what gives the best benefit or best information to our shareholders. And that's how we actually think about and we come up with GAAP. And GAAP then gives us some guidance around which costs should be capitalized, which ones should be expensed. What we're going to look at now is depreciation, and this forms the bulk of this chapter. Now, I will tell you right now, you will be expected to calculate depreciation a lot in this course. So I do encourage you guys to make sure you practice the straight line approach, the units of production approach, and then finally the declining balance approach. And you are responsible for all three. Give this a lot of practice. This is one of those areas that is heavily, heavily tested. Okay. To recap, depreciation itself is an allocation of cost to the over its useful life. Okay. Early on in the course, I didn't really spend a lot of time talking about this thing called salvage value, but the idea here is some equipment you could sell at the end of its useful life. If we can sell something like a building or a car at the end of its useful life, then the net cost to us is the cost we paid minus what we could sell it for. So with depreciation, we're allocating the cost over its useful life. And the idea here is to match the asset's cost against the revenue earned by the asset. This is not a cash outflow, right? When we depreciate something, we're not spending money at that time. For intangible assets, the word we use is amortization. For tangible assets, we use the word depreciation. The calculation is based on cost, estimated useful life, and salvage value. These things are estimated by management. Cost is known. The useful life, we make a guess. And salvage value, we're making a guess. Another word for salvage value, by the way, is residual value. The useful life is the length of service expected from the asset, and it could be expressed in years, but it could also be units of output like kilometers, right? If you're talking about a car, how long does a car typically last? Well, maybe 200,000 kilometers. And then the salvage value is the amount we expect to be able to sell it for, as I mentioned to you. Okay, this is a really good review slide. Land is not depreciated. Land improvements are depreciated. Buildings are depreciated. Resources, we use the word depletion or amortization. So for example, if you've got a gold mine and you're taking gold out of the mine, you're depleting the mine. An intangible asset is amortized. So an example here would be a patent that lasts 20 years. You'd be using up 1/20th of that patent every year. We also talked about something called goodwill, which is the excess we pay over the net assets of a company if we're buying another company. We can't put our own goodwill on our books, but if we buy some other company, we've got goodwill on the books, and then we've got to test that goodwill for what's called impairment. And what that really means is that the goodwill isn't worth to us as much as we initially thought it was worth when we first bought it. So for example, let's think back 20 years ago. Maybe Kodak buys a company that is really good at making film. And in buying that company that really makes film, at the time, right, digital cameras weren't as popular, so those film companies must have been worth a lot. And they might have said, oh yeah, this is going to have a ton of future benefit to us. And then, well, we all know what happened. The digital camera has taken over, and now we'd have to record an impairment loss because that goodwill no longer is worth what it was. Okay, let's talk about the different depreciation methods. The first depreciation method we're going to look at is called straight line. And the idea here that we've already seen actually is to allocate an equal amount of depreciation to each year of use. Units of production does the same thing, but instead of dividing by time, we divide by an estimated unit or number of units of output. Right, so if we're talking about that car, maybe the car is for 200,000 kilometers. If we're talking about a machine, maybe it can only make so many units before it dies. And then declining balance, there's what's called single, double, and triple declining balance. We are only going to look at double declining balance in this course. So even though your book might get into a couple of other methods, the one we're looking at is double declining balance, and we'll talk about that one in just a second here. Okay, let's look at some calculations, and let's just keep this really simple. Assume that we buy a truck on January 1st. The year end is December 31st. The cost of the truck was $65,000. We expect to sell it for $5,000. And that means that we're going to spread out $60,000, right? The 65 minus the 5. That's called your amortizable cost or your depreciable base. We're spreading that cost out over the useful life of 5 years. Or if we're going to use a units of production method, over 400,000 kilometers. Take 30 seconds. See if you can work out the straight line depreciation cost. And you should have got $12,000 per year. So the journal entry there would be debit depreciation expense, credit accumulated depreciation, 12,000 and 12,000. As a friendly hint though, this book uses the word amortization for all types of property, plant, and equipment, even though what they should be using here is depreciation. Okay, what I want to show you here is that the truck was purchased for $65,000. The book value after the first year is the $65,000 minus the $12,000 in accumulated depreciation. That gives you $53,000. In the second year, we're again going to depreciate another $12,000, meaning that our accumulated depreciation will be $24,000. $65,000, which was the cost, minus the $24,000 gives you $41,000. Now we keep doing this until we get to the last year, and what I'd like you to notice here in our last year is that just the way the math is now going to work out, when we depreciate in our last year, our accumulated amortization will be $60,000, not 65, but 60. And the 65, which was the book value, minus the 60,000 gives you a residual value of $5,000. And again, I'll leave this slide up for a couple of seconds here just so you can take a look at it and walk through it. Let's use units of production now. We take the cost minus the residual value just like before, but now instead of dividing by the amount of time, we divide by 400,000 kilometers. This gives you 15 cents per kilometer. From there, we're going to make our estimate based on our cost per kilometer. So here, we're going to be told maybe we drive 90,000 kilometers in year 1, 120,000 in year 2. We'd only know these numbers based on what actually happens in that year. So in the first year, we'll take the 15 cents times the 90,000 kilometers we drove. In the second year, we do the same thing, times the number of kilometers, and so on. The only tricky part here is that in the last year, even if the number of kilometers doesn't equal what we expected it to be, we will plug the depreciation expense in the last year to force the accumulated amortization or accumulated depreciation to be 60,000. Okay, this is a little tricky, so I just want to quickly make sure that this is clear. In our last year, the depreciation we're going to record in units of production will be exactly the amount needed so that the book value is equal to the residual value in the last year. In this particular instance, it worked perfectly, right? 15 cents times 30,000 gave us 4,500. But what if the number of kilometers driven in that last year were only 20,000? We would still record 4,500 as our depreciation expense. Okay, so that is a little bit tricky. Finally, we get double declining balance. So here we're going to take the straight line rate. If the useful life was 5 years, then 1 over 5 gives us 20% per year. Doubling that gives us 40%. That means our double declining balance rate is 40%. In each year, we're going to multiply the asset's book value by the rate to get the depreciation expense for that year. Now be really careful. In both the straight line method and the units of production method, we used cost minus residual value and divided that by the useful life. In the double declining balance method, you don't do that. Notice we're taking 65,000 here times 40%, not the 60. Okay, let me put this up on the screen so you can see as this how this calculation goes. Okay, we buy the asset for $65,000. We've worked out that the double declining balance rate is 40% or 0.4. 65,000 times 40% gives you a depreciation expense of $26,000. Our accumulated depreciation is now $26,000. Our book value, or our carrying amount, they're the same thing, is 65 minus the 26 gives us $39,000. 40% of 39,000 gives you 15,600. Our accumulated depreciation then is 26 plus 15,600. Right, the 26,000 last year plus the 15,600 this year, giving us $41,600, or an asset book value now of $23,400. In the next year, we take the $23,400 and again multiply that by 40%, and we keep doing this for the next few years until we get to the last year. And in this case here, the amortization or the depreciation is the amount needed to reduce the book value to the residual value of 5,000. So it doesn't really matter what the depreciation expense would have been. We're plugging it to be 3,424 because that's what's needed to go from 56,576 in accumulated depreciation last year to 60,000 this year. I find generally this is where you guys would tend to have questions. So I'm just going to pause for a quick second here and keep an eye on the group chat. I know we're delayed by a couple of seconds, so let me just take a look and see. If you need me to go back to any slides, let me know. And again, I can do that. Just let me know specifically which slide to go back to. Okay. Got an all good, so I'm going to move on. Okay. If you compare the three methods, what I'd like you to see here is that regardless of the method you use, at the end of the 5 years, we've got a total accumulated depreciation of $60,000. Which means the residual value at the end of 5 years is $5,000. That takes us to the next part of this chapter, which is looking at depreciation for tax purposes, dealing with partial years, and then changing your estimates because depreciation is based on estimates. First of all, for tax purposes, we'll keep this really simple. You will be keeping a separate record for tax because the government requires you to use a modified method of double declining balance. Basically, it works the same way, except instead of us calculating the rate, the government has a bunch of different classes of rates that they give you. Those are called capital cost allowance rates. And they tell you that for this particular thing, it's 20%. For this thing, it's 50%. And you'll use that rate that they give you. Okay, and you can claim up to what's called the CCA amount. In your first year, the government doesn't really want to be tracking when you bought the asset. So they're going to assume you bought it halfway through the year. And that means you can only claim up to half the CCA deduction in your first year. I'm not expecting you that you guys know very much about CCA other than to say that it exists, that it's subject to what's called the half-year rule. So you can only deduct half the CCA in your first year. And that the rates are given to you by the government. If you're depreciating for a partial year, then what we're going to do is we're going to prorate, or we're going to reduce the amount of depreciation in that year by the number of months. So assume a business with a year end of December 31st buys a building for $600,000 on April 1st. It has a useful life of 18 years, a residual value of $60,000. So 600,000 minus the 60,000 gives you the depreciable amount. We divide by 18 years, that gives you $30,000 per year. In the current year, we bought it on April 1st, so our adjusting entry on December 31st will take the 30,000 times 9 months over 12, right? So April, May, June, July, August, September, October, November, December. You can't see me, but I'm counting on my fingers right now. That's 9 months. 30,000 times 9/12 gives you 22,500. And in our first year, then, we'll depreciate $22,500. For units of production, we still do this by unit. And for double declining balance, again, we'll prorate based on the number of months. Some companies will have different policies around how they deal with partial months, by the way. In our class, just to keep it simple, if we buy something after the 15th or before the 15th, we use that as to whether or not to include the month. Don't worry, I'm not going to give you something exactly on the 15th. But let's say you bought it on the 3rd of the month, we would include that month for depreciation purposes. If you bought it on the 26th, you would not. Okay, so we wouldn't count that month. What happens if you want to change the useful life of a depreciable asset? Well, here you take the cost, you add any betterments you've taken or done to the asset, you subtract the accumulated depreciation, you subtract the new residual value, and you divide all of that by the remaining useful life in years. Again, this isn't as tricky as it sounds. Basically, you take whatever you paid for the asset and anything you've added to its cost, right, by making any betterments to it. You subtract any accumulated depreciation you've already recorded. So this gives you the book value at that time. From there, you subtract your new residual value to get a new depreciable amount. And then you divide that by the useful life in years. What if you're using a fully depreciated asset? Well, some businesses will continue to use an asset for a long time, even after it's fully depreciated. Maybe you completely misestimated how long you planned to use the asset for. Well, here you don't keep depreciating it, but what you do is you do show it at its cost, and you show the full amount of accumulated depreciation, so it's clear that you're continuing to use the asset. Well, what could we do instead once we're done using the asset? Like, what if we want to get rid of it? What we're talking about then is the disposal of property, plant, and equipment. Okay? I hope you like that segue. I've been rehearsing for a long time. How do we get rid of property, plant, and equipment? Well, we can either sell it, exchange it, or junk it. Now, if we're just getting rid of it, it becomes a really easy transaction. The idea is we're going to bring any depreciation up to date and then get rid of it. If we are going to sell the asset, we've got to work out what's called a gain or a loss. And again, we'll look at that in just a few minutes here. You are going to remove the asset. You'll remove the accumulated depreciation, so it's contra account. You'll record any gain or loss, and then you'll record any payments or trade-ins or anything like that, if any of that exists. Again, this can start out really simple, but it can get fairly complicated. This is where we are going to spend a fair bit of time, because disposals, I find, give you guys a really hard time. Any questions up to here? Okay. Well, it looks like there's not a lot of questions here, so let me just move on and we'll do this. Let's assume a business is disposing of a machine that cannot be sold or exchanged. Okay, it had a cost of $60,000, accumulated depreciation of $60,000. So think about your T accounts. Under the equipment itself or the machine itself, you would have a cost of $60,000. On the accumulated depreciation side, you've got a credit balance of $60,000. We need to get both of those off of our books. So here we're going to debit accumulated depreciation, which makes that zero. So it takes that away. And we're going to credit the machinery account to get rid of that, right? So that makes that go away. So now both the cost of the machine as well as the accumulated depreciation have both been set to zero. That particular piece of equipment is now off of our books. If we junk the assets before they're fully depreciated, then we're going to have a loss. So here, assume fixtures costing $40,000 with accumulated depreciation of $30,000 are junked. So here we've got a $10,000 loss. Again, we're going to get rid of the accumulated depreciation. So we're going to debit that for $30,000. We'll debit the loss for $10,000. We'll credit store fixtures for $40,000 or whatever the particular property, plant, and equipment is. And again, that gets rid of that. That loss will show up on our income statement. Remember, we talked about this last week under the multi-step income statement as other expenses. Right? So this is an example of an other expense, a loss on disposal. The only difference here is if you sell it, you've got to record the cash you actually receive when you sell it. So the only thing that changes to that journal entry now is that we've got the sale itself. So step one, bring your depreciation up to date. If we're selling it, let's say in May, and we haven't yet done our depreciation for the year up to May, well, we would record January, February, March, and April's depreciation, and then we would sell the asset. We're going to debit the accumulated depreciation to make it zero. We'll credit the asset itself. We'll record any gain or loss, and then we'll record any payment or trade-in if applicable. Let's take a look at this. On September 30th, a company sells some office furniture for $50,000. The original cost was $100,000 when purchased on January 1st, 2014. Look at the years. It was being depreciated over 10 years on a straight line basis, with annual depreciation expense being $10,000. So the first thing we need to do is update the depreciation. Between January 1st, 2017, not 14, but 17, and September 30th, 2017, 9 months go by. $100,000 divided by 10 years, that's your $10,000 per year, times 9 over 12 gives you $7,500. Now, what I want you to do is I'm going to pause for a quick second here. Try to work out what the accumulated depreciation would be at the point of disposal here. Again, take about 2 minutes and then see if you can come up with what that journal entry would look like to get rid of the equipment. Okay, so again, I'm going to treat this like it's the real deal. I'll give you about 3 minutes to work on this, and then we'll come back and continue on. I'll just leave this running here, and I'll see you guys in 3 minutes. Okay. So let's just see how this went. You're going to be debiting cash for 50,000, right? We received $50,000 in cash, so cash goes up by 50,000. Here we're going to have a loss on disposal of 12,500. We'll be debiting the accumulated depreciation for $37,500, and we're going to credit furniture by 100,000. So the important thing here is, well, one, were you able to work out the accumulated depreciation of 37,500? The credit to furniture would be 100,000. The debit to cash would be 50,000, right? That's how much cash we received. I'm not sure if you guys can hear that sound in the background, but that's my dog walking on the floor here. And she's just kind of prancing around. So sorry about the noise in the background. Okay. What if we trade property, plant, and equipment? The idea here is you're exchanging one asset for another. Well, first of all, we've got to ask, is there commercial substance or not? If there's commercial substance, then we're going to record the new asset at fair market value, and we're going to record any gain or loss on the old asset when we actually trade the assets. If there's no commercial substance, then you record the asset at book value of the old asset. In our class, and generally, we're going to assume that the transactions have commercial substance, and what that really means is that there's a change in our cash flows as a result of getting this new asset. Okay, so maybe we're exchanging an old car for a brand new car, right? And this new car is going to be a lot better than the old one, or something along those lines. I see there's a comment on the chat about the dog. I promise I will show a photo of her next class. She is adorable. Okay, Lola, come here. Come here. There are people you're distracting. Yes. Yes, you. Okay. I hope you guys admire my professionalism on this chat here. Okay, so let's take a look at an example of this exchange. Assume a truck with a cost of $42,000 with accumulated depreciation of $30,000 is exchanged for a new truck with a fair market value of $53,000. So they're going to throw a bit of extra information at you here. We've got fair market value of $53,000. They give us a trade-in allowance of $8,000, and what that means is they're going to give us $8,000 off the sticker price. Okay, we're going to pay $45,000 in cash. Now, we are going to say that this transaction has commercial substance because we're getting a new truck in exchange for the old truck. Okay, and this new truck is going to be better. What would be an example of something that doesn't have commercial substance? Maybe we are exchanging an old TV for a new TV on warranty. So, you know, one of our TVs got damaged and they give us a replacement that's identical to the one we had. There'd be no commercial substance there. The old TV and the new TV are exactly the same machine. Okay, so here we're going to debit the new truck at its fair market value of $53,000. Don't worry about the loss just yet. We'll come back to that. We're going to credit the old truck account for $42,000, right? That was its old cost. It would still remain at its cost. We're going to credit cash for $45,000. That's the amount of cash we paid. We're going to debit the accumulated depreciation on the old truck. That was $30,000. Right, we had owned it for 5 years at $6,000 per year. So the difference between all of that, are we short debits or credits? In this case here, we're short debits. The reason we're short debits is we're incurring a loss on this. We gave up more than we actually got. And in exchange, we've got a loss here of $4,000. Okay. We then have to talk about the internal control around property, plant, and equipment. The idea here is that includes safeguarding them, having adequate controls over our property, plant, and equipment, making sure we've got insurance for fire, storm, and other losses, making sure we've got good security on hand, and so on. As an example there, if you look at the projector, for those of you sitting in the classroom right now, it's bolted to the ceiling. It's using security screws. So they've got some controls that are in place to help prevent theft or loss of the expensive stuff in the room there. The chapter also gets into natural resources. We don't spend too much time on them in this course, but just to keep things really simple, We do call them wasting assets because they are used up in the process. Examples of that would be things like iron ore, coal, gas, oil, timber. Typically, we use the account depletion, and we use units of production. So how do you figure out the amortization expense per resource? We take the cost minus the residual value. We divide by the total number of units of natural resources. And then we multiply the number of units of that resource that we pull out of the ground. Now, one interesting thing about this is depending on the book, this is treated slightly differently. This book records the depletion as amortization expense, and they record a corresponding accumulated amortization. Other books, I think, are actually better. What they do with that is they record inventory. So, for example, if we're pulling gold out of the ground, instead of debiting an expense, they'll say, well, that gold that we're pulling out of the ground is actually inventory. All right, so they're going to increase the inventory account. For this course, I think we're going to use the inventory account, and I'll show you an example of that hopefully a little later on next class when we get to it. It's not meant to be tricky, but instead of using depreciation expense, we're just going to debit the inventory account. This one here, we don't need to actually do journal entries for, not in this course. You'll deal with them in intermediate accounting for those of you doing intermediate accounting. There are costs that we have to be aware of that have to do with future site restoration costs or putting the land or the place we're working back to its original condition before we started working with it. That's called an asset retirement obligation. We have to disclose it in the notes to the financial statements, but it also becomes a cost that's part of the cost of the land, and we have to record that in today's dollars. Again, because it requires some finance to it, we don't do a lot of that in this course other than just to mention that it is a cost. It is a real cost. We are going to make the estimate for that cost and record it as part of today's cost of the asset, even though it might not be a cost we incur for another 20 or 30 years. Okay, and then there's goodwill and intangible assets. And again, we're not going to spend too much time on intangibles in this course. There's already a lot in this chapter. Okay, so just kind of working through this here. Intangible assets don't have a physical form to them. In fact, the word tangible comes from the word tango, like the dance, which means to touch. So if it helps you think about it, a tangible asset is one you can touch, and an intangible asset is one that you can't touch. Okay, they have no physical form, but they do give you some future benefit, right? If you've got a patent, it means you're the only one who can do that particular process. If you've got a copyright or a trademark or a Subway franchise or a McDonald's franchise, it lets you use those intangible assets to run a better business than someone without them. Now here, we amortize over the lesser of the legal life or the useful life. If a patent is useful for 20 years, but only has a legal life remaining of 10 years, well then unfortunately, you'll have to amortize it over 10 years. Now, there is one sneaky thing with accumulated or with amortization of patents or intangibles. And that is, as we use up the intangible, we are actually using up the intangible. Like a patent that was supposed to last for 10 years, after 1 year only has 9 years worth of life left. So there, we're not going to use an accumulated amortization account. We're actually going to credit the intangible asset itself. So here we're buying a patent for $2 million. It's got a 5-year life. We'll credit cash. And then as we're amortizing it, so now we can use the word amortize, we'll debit the amortization expense for the patent and credit the patent itself. Okay. The book does get into the differences between the different types of intangible assets, copyrights, trademarks, franchises, and then goodwill. I'll let you read about those. The one thing with goodwill is we test it for impairment. So assume Purolator buys Regional Express for $10 million. The assets are $9 million. Total liabilities are $1 million. We paid $10 million. In exchange, we're getting net assets of $8 million. So the difference there is $2 million in goodwill. The journal entry to record the acquisition would be to debit assets. So each of the respective assets for the $9 million we received, we'd credit the liabilities for the $1 million in liabilities. We'll credit cash for the 10 million in cash we paid. And then we need to deal with that difference of 2 million bucks. And that's why we've got an asset called goodwill, which is 2 million. Effectively, we paid more for that particular business than the net assets, probably because of the reputation it has. Right? So when Facebook goes out and they buy Instagram for several $1 million, well, again, part of that is because they believed, several $1 billion. They believed that the future benefit of Instagram was a lot more than what they paid. Goodwill is only recorded by the company that acquires another company. It has an indefinite useful life, so it is not depreciated. It does need to be tested annually for impairment. Okay, so you are testing this regularly. And if it is impaired, we do what's called a write-down. So the language, or in accounting, we refer to it as a write-down. That's just the word they use, and that just means that it was impaired. It means that it lost some value, which in this case was $500,000. So here we'll debit loss on goodwill, or an impairment loss of $500,000. We credit goodwill. Okay. What we're going to do in just a minute here is we're going to start getting into some questions. We're at about 3:25 right now. We'll pause like we typically do just to give you guys a chance who are at home or who are in the classroom to take a quick break. And what I'll do is I will post on D2L the link for the next part of this. I am going to switch to my laptop so we can start working on some questions. I'll see you guys in about 5 minutes.